Infinite Banking 101. This is what you're here for. Let's give you a nice little easy crash course into what is infinite banking and how does it work. All right, so you're probably looking for something like Infinite Banking 101, like what are the basics? How does this really work? How do I use it? Why is there all this excitement about it? Well, that's why I want to go into this video today. And just so you know, there's a difference between infinite banking versus max ROI infinite banking, which is what we promote. I'm going to talk about the difference here in a second. All right, so infinite banking, right? This concept was created by Nelson Nash and the Nelson Nash Institute. Shout out to you guys there. Nelson Nash Institute created this concept of infinite banking. Now, what they were using is they're modeling this after banks and what they were doing, because banks were actually using life insurance as well. They actually use money to store money in life insurance so then they can create more leverage. For them, it's some of the best place they can store their capital because not only is it safe, but it gives them the ability to loan out more money. Now, granted, we don't have all the same rules as a bank does. However, when you have money coming in and out of your life, what's nice to know is, what if I can get that money to work harder for me? Because the truth is, when money's going out, you get paid nothing on that money, do you? Like when it goes out to expenses, it's gone. When it goes out even to investments, it goes out into one place and it makes money there. But the nice thing about infinite banking is you can actually earn money in two places at the same time. Now, how do we utilize this? This is typically utilized using whole life insurance. Whole life insurance is different than term insurance. Term insurance is just death insurance, right? It's an expense. You pay for it. It's just like car insurance. You only get paid out. Actually, you don't get paid out because you're in the coffin. Your heirs, your spouse, your family, they get paid out when you die. And so term insurance is just that. It just covers you for a certain period of time, and that's it. Whole life insurance can cover you your whole life, and it doesn't just have a death benefit, but it also has this tax-free savings account they refer to as cash value. This tax-free savings account is money that you're able to put in with after-tax dollars, grows tax-free, you can access it and pull it out tax-free. Kind of like a Roth IRA, but you don't have a lot of these other limitations based on if you make too much money or how much you can actually put in each year. There's a little bit more flexibility of how much you can actually contribute to a whole life insurance policy. And you can actually still use that money now. There's no 59.5 rules and things like that. Not even early withdrawal penalties of that nature, right? So it's kind of nice. But here's the real benefit. I mean, besides the fact it's a great place to store money, because I store a lot of my cash here, the real benefit, of course, is I can actually get my money to be leveraged to use in two places at once. Because what many people don't realize, you might see infinite banking stuff out there. They say you borrow money from yourself and then you pay yourself back, right? You go and buy a car with it. This is what traditional infinite banking will say. You know, like in Nelson Nash's book, Be Your Own Banker. Good book if you want to get a basic understanding of this. But he says go and, instead of paying cash for a car, go and use your life insurance, use the cash for your policy to go pay for the car, and then the payments you would have paid to the bank, instead pay to yourself back. Now, the deception is a lot of times people misinterpret what that means. They think, oh, I just pay myself back interest. This is great. I'm making money off my money by doing that. It costs me nothing. That's not true. Here's how it really works. If you pull open the hood, right, you open up the hood here, you see what's under the car here, you realize there's different components to this engine. One, you do not borrow money from yourself. You borrow money from the insurance company. And yes, you can even do it from certain banks. They call them IBLOCs, like HELOC, home equity line of credit. They have what's called an insurance bank line of credit too. Well, insurance companies will give you a private line of credit as opposed to banks. Private line of credit doesn't show up in your credit report or anything. No minimum monthly payments, which is different than what the banks might do. They might require monthly payments for the banks. But the insurance companies don't require monthly payments, but they do charge you interest. So when you're paying the money back, so to speak, right, you're paying back to yourself, you're really paying back to the insurance company to pay down their line of credit, which frees up your money again, because they're using your cash that's in the account as collateral. So they're just giving you a line of credit on your money that's already sitting there. But this is where it's better than what most people have been selling you, because they'll tell you, oh, you just pay yourself back. Okay, great. But here's where it's better. Because the insurance company, you borrow from them, and yes, you pay them interest. But remember, you didn't pull out your own money. You do have that option, by the way. You can withdraw money from your account. But the reason why so many of us will leave it in there is because they're paying us tax-free compounding interest. So that money keeps growing and compounding each year, guaranteed. While the money over here, if I use that money to put into something where I do pay it back, paid principal and interest, well, then the balance of the principal, the balance of your loan goes down, meaning that less and less is charged to interest, right? That's the difference. That's simple interest versus you're earning compounding interest. Two very different interests being charged. It's just math. It's nothing different. Just like the insurance company, I mean, they are literally like a bank, the bank line of credit. It's not like they're screwing you in the beginning. It's purely because they're charging you interest based on the loan balance. So the faster you pay down the loan balance, the less you get charged in interest. While on the other side, they're compounding the amount of interest they have to pay you. That's where somebody says you can actually make more money. So when they say you're paying yourself back, no, the insurance company's paying you for that money that's still in there, and you're paying it to them. The goal is you pay at least interest only so that it doesn't compound against you. That's the real trick. So if I go and do a real estate investment, let's say it's $100,000 and I'm making 10% a year, that $10,000 goes to pay towards that 6% plus loan. And what happens is that I pay that down to $96,000. I paid $6,000 interest, now it's $96,000. Now the next year I'm charged 6% on that $96,000, right? So it's a little bit less than $6,000 that's being charged. I pay it down, and guess what? Now it's down to just under $92,000. The third year I do it again, and guess what? Now it's going down to about $87,000. So the interest I'm paying goes down, it's shrinking less and less. While on the other side here, those 3 years, hey group, say they paid me $6,000 or 6% as well, $6,000 the first year, $6,000 and change the next year, another $6,000 and more change the year after. I'm increasing the amount of interest I'm earning, while on the other side, I'm decreasing the amount of interest I'm paying. Therefore, I make a spread on the interest here, while at the same time, I'm able to invest that money in real estate and still make money in my real estate too. That's the difference. That's how you make money in two places at the same time when I say that. That's how infinite banking, in my opinion, really works. Now, here's all the skepticism about infinite banking, right? They'll tell you whole life insurance is very expensive. True, very true. Especially if you get a traditional whole life plan, those first few years you have zero cash. Everything goes to insurance costs. This is again why we refer to our concept as max ROI infinite banking, because we try to lower the cost as low as they can go. We don't try to get big death benefits. We try to get low death benefits for the maximum amount of cash that's allowed for that death benefit, cram that money in so that you pay less in insurance costs and the cash grows from day one. You have cash actually in there. Almost all your cash is in there from day one, even in the most expensive year. And by usually the third year, it's already paying for itself, or it grows by more than what you put in. And so if you can reduce those costs, it allows you to have more cash to leverage and use faster to make more money. Because the plan is not just put all your money in this life insurance and that's all you do. No, you'll never become financially free just off your life insurance alone. It's about how do I take this money and get it to invest in other places, even outside of what a financial advisor would recommend, like real estate and business and things like that, to make more money, create more wealth now, and then of course I can use that policy as some of the emergency fund or some of those savings or reserves I can use to make money in those places. That's really simply all it is. It's just a place to replace my simple checking or savings account that I would use to do certain big purchases or investments. Some people like to talk about doing it with small purchases. Personally, I don't. I like simple is better. This is why you're doing 101, right? For Infinite Banking 101. I like simpler the better. And so I only use this for one, cash reserves, because I'd rather make 6% tax-free on my money than putting it in the bank, making nothing percent and getting taxed on that money. That's one big reason. So I keep bulk of my cash reserves in my policy. Anything above that is free game to invest with, and I generally only do that after I've already gotten rid of all the other cash that's making no money in my bank, right? So once I've done that, then my next cash reserve storage is my life insurance that I'll use to invest, and yes, I can make money in two places at once by doing that. But again, I'm only doing like bigger purchases or bigger investments, things like that, not just tiny little things that really just complicate my life. Again, you can use it however you want. There's so much freedom and flexibility, but that's why I do it. And that's why I prefer using whole life, because I can make it a lot more flexible and get more returns out of it. Now, here's what I would not do with this policy is I would not use this necessarily to go buy a car or a house like they talk about in the traditional infinite banking. The reason being is this, is because, like I said, we're paying interest to the insurance company already. But if I can get that same money from a bank and I don't have to use my own money, I'd rather use the bank's money to go purchase these things that are probably less than 8%. So for example, I'm gonna go buy a house and put a mortgage on it because, again, the bank gives me money and I can keep my cash available for other things. In fact, if I were to buy a property and I have to put 20% down, yes, I can use my life insurance to put the down payment, but get the other 80% from the bank so that I'm not leveraging all of my cash for my policy. The other thing too, cars. People say, oh, I can buy cars with it. Yeah, but I can still get a 7% loan or even less. I got a 3.99% loan last year on my car because they offered a special. I said, great, I'll take that and not use my policy. Now, granted, if I were getting like credit card type of interest rates charged to me for houses or cars or whatnot, yeah, I would probably consider using my bank instead. My own personal infinite bank, I would use that instead. But because rates are still relatively low in those specific areas, even student loans and things like that, I'd much rather use my money for that. So that's a big thing that I like to do as well, is I like to use that money use the cash for things that the bank won't lend me money on, especially if they won't give me a good interest rate, then I'll use my infinite banking policy. But for everything else, I love leveraging the banks. Now, who's this not for? If you're someone who's in horrible health, right? Maybe you've had like heart attacks recently or something like that, or cancer recently, you're probably not going to get a good rating. You probably want to look at another family member instead if you're going to do a policy on them, which you can also own and control. I'd also recommend if you're over the age of 70, we probably wouldn't be using this strategy as much of using this to invest or anything else, but it could be a great way to also create an estate plan. And then lastly, if you can't save at least $5,000 or $10,000 a year, I probably wouldn't do this. I'd probably get what's called a convertible term and life insurance policy. It's just death insurance, but something that's convertible to whole life later on, and do that instead while you're trying to get your cash flow increased. And then when you got at least $5,000 or $10,000 a year you can save, then we can do whole life, do that infinite banking type of strategy. The great thing is, guys, like the younger you are, the better the return. The younger and healthier you are, the better you get from it. So that's the thing I recommend is that, don't procrastinate, don't delay. If you can do it sooner, I would work on doing it sooner, because I've had too many clients in their 50s and 60s saying, why didn't I do this 20, 30 years ago, right? And so that's why they end up trying to get their own kids to do it in their 20s, because they realize just how amazing this concept is and how much it can help you create wealth right away, especially when you use it to invest in alternative investments instead of just doing your plain old mutual fund stuff, crap that a financial advisor sells you and then you don't really make any good money from it. So that's why we use it. It's using in combination with those other things like business and real estate to create greater wealth right now. That's the benefit of infinite banking, at least from what we do with Max ROI Infinite Banking. If you guys want to go further down that rabbit hole, go to moneyripples.com, click on infinite banking. You can actually learn a lot more that way as well on what's actually even possible to help you build your cash and actually build your wealth faster.